Hey everyone, today I want to take a look at two of the largest low-cost retail stores in the United States, Walmart and Target. Walmart and Target has made some very large investment into the e-commerce business to stay relevant and to fend off online retailers such as Amazon. There are not a lot of retailers that are able to keep up with Amazon, but Walmart and Target has been able to hold out by turning their stores into fulfillment centers. First, as a disclaimer, I just want to say I'm not a financial advisor, so please do your own due diligence before investing. Walmart is the larger of the two, and by quite a bit, over 5 times larger than Target by market cap. Walmart also trades at a higher premium to Target when we take a look at PE ratios at 23.25 for Walmart and 18.5 for Target. Target has slightly higher yield than Walmart at 2.28% versus the 1.82% for Walmart, but their payout ratio is about the same for both. When we take a look at their yearly revenue numbers, we can see that Walmart just dwarfs Target. We do notice that it is starting to plateau back in 2015 to 2017, but with its heavy investment in the e-commerce business, especially when they bought Flipkart, we do notice the revenue numbers are starting to grow again. If we zoom in, we can see that Target did have a time when it was growing its revenue significantly, but the recent decade it has slowed down. But in the recent several years, it looks like they are picking it back up, and we'll see if they continue that growth going forward. When we take a look at the yearly profit numbers, we can see that Walmart's profits has really taken a nosedive in the recent 5 years with their heavy investment into the e-commerce business. But some good news is that it is picking back up. Their trailing profit is back up to $14 billion. Target, on the other hand, has had 1 year where they lost money, and that was related to their operations in Canada. Target Canada was losing money every day, and back in 2015, they decided to pull out of Canada, and during that time, they had racked up a loss of over $2 billion. We do notice that Target's profit has been plateauing, but their trailing profits has also jumped up to over $3 billion, so they are starting to grow their profits again. When we take a look at their profit margins, one thing we do notice is just how low their profit margins are, but both Walmart and Target's profit margins has been very consistent over the years, except for a few outlier data points. With Walmart, in the recent couple years, their profit margins has really dropped a lot because of their heavy investment into e-commerce. And with Target, if we ignore a couple data points of when Target entered Canada, both Walmart and Target's profit margins has been fairly consistent over the years. Again, when we take a look at their earnings per share, we see a very similar chart again. Their earnings per share has been pretty consistent with each other, except for the 2014 and 2015 data point, which is when Target entered Canada, and also the recent few data points for Walmart, which were when they acquired Flipkart, as has negatively affected Walmart's profits. But again, some good news is that both Walmart and Target's trailing earnings per share has moved back up to $5.01 for Walmart and $6.26 for Target. One chart that I really like is their shares outstanding. We can see just how many shares Walmart has bought back, and they are constantly buying back more. Same with Target. By buying back more of their shares, it will help them boost their earnings per share, which will then allow them to further grow their dividends. When we take a look at the yearly dividends, they have really grown a lot over the years, but we can notice that it is slowing down, especially with Walmart, which is probably attributed to their heavy investment into e-commerce. We can see this very clearly when we take a look at the dividend growth. Walmart's dividend growth has really been declining over the years, and we can see why in just a second. Same with Target. They initially grew it very nicely, but in the past decade, their dividend growth has really slowed down as well. We can see the reasoning why when we take a look at their payout ratio. If we take a closer look at Walmart, we can see their payout ratio increasing over the years as they have grown their dividends. The most recent data point isn't very accurate as it is close to around 40-ish%. But still, they are paying out a good chunk of their profits back to their shareholders, and they probably will still need to invest back into the company to stay relevant. We can see a very similar situation with Target. It's just that they have been growing their dividends faster than the earnings per share growth, and since that's caught up to them now, they have to slow down their dividend growth to match their earnings per share growth in order to maintain their payout ratio. When we take a look at their 20-year stock performance, we can clearly see Target on top, especially in 2019, as Target's PE ratio starts catching up to Walmart's. But does Target deserve the same PE ratio as Walmart? When we take a look at their annualized return, we can see a very similar trend to each other, except for the recent couple years where Target has really outperformed. But if we look further back, their performance hasn't been too far off from each other. But overall, in my personal opinion, which one do I like? I think they're both great and I own both. Even during a recession, people still have to eat, and more likely than not, people will be shopping for discounts, and where else better to buy it than at Walmart and Target. But if I had to pick only one, I think I would lean more towards Walmart, but of course, if one is selling at a discount to the other, I wouldn't hesitate to purchase it unless there's a fundamental problem. But these are just my own personal opinions. I'm not a financial advisor, so please do your own due diligence before investing. And as always, if you enjoyed the video, please like and share the video. I really appreciate it because making these videos does take a lot of time to do the research on these companies, and it really helps out the channel. And if you haven't subscribed yet, please make sure to smash the subscribe button, and thank you for watching. I'll see you in the next video.